Very good evening, my dear participants and other faculty members, those who have joined for the session. I am Lieutenant Dr. Ranganath, working as a lecturer in Commerce, Government College, Autonomous, Anantapuram. Today, I am going to deal with the financial statement analysis. First, before going into the financial statement analysis, we will try to understand what is the meaning and importance of the financial statements. As and when we heard the financial statements as a commerce member, we will think about the profit and loss account and balance sheet. And these are the two important financial statements which generally prepares any accountant to know the financial results and financial position at a period of time for any business enterprise. These financial statements always uses the data which is extracted from the accounting systems. Whenever we are preparing lectures, journals, and trial balance, from there we will extract the data to prepare the financial statements. And this accounting system always performs its main function of providing summarized information about the financial affairs of the business at the time of preparation of financial statements. That means the base for the financial statements is the process which is involving in accounting. That is journal, ledger, trial balance. These are the three important sources for preparation of profit and loss account and balance sheet. The financial statements comprise, as already I said, that balance sheet is also known as position statement because this balance sheet is showing the financial position at a point of time, at a period of time, and statement of profit and loss or income statement is showing the financial results. Whereas the Companies Act 2013, as per the Companies Act 2013, Section 2, subsection 2 and Section 129 as well as 133 says every company has to present its financial statements in the form in a specified format. The sections are Section 2, subsection 2 as well as Section 129 and 133 gives a clear picture how to prepare and present the financial statements by the companies as per the Companies Act 2013. And then what is the significance of financial statements? When you look into the balance sheet and profit and loss account, these are the very, very significant financial statements. Balance sheet shows the financial position on a particular date, usually at the end of the 1 year period. As we all know that the financial or accounting period start from April 1st and end with the 31st March. For that 1 year period, we need to know the financial position of any business enterprise. We need to look into the balance sheet. The balance sheet will be extracted or prepared based upon the available accounting processes that first book of entry and then that is a journal, ledger, trial balance, as well as balance sheet shows how the money has been made available to the business of the company and how the money is employed in the business. Balance sheet not only projecting the financial position of a business, but also it shows the money which is made available to the business as well as how this money is employed in the business for purchasing different assets or for making investment in different avenues. That means how the money has been inflow, how the money has been outflow, that is also you can observe through the balance sheet. Hence, the balance sheet importance is indispensable in any firm, either it is manufacturing, trading, or service enterprise. The balance sheet is most important. And then coming to the profit and loss account, which is also known as income statement. Earning profit is the principal objective of business enterprises. We all know very well that any business enterprise, the earning profits is most important. Without profit, the surveillance itself is a problem. Hence, earning profit is the principal objective of all business enterprises. Profit and loss account or income statement is the document which indicates the extent of success achieved by a business in meeting this objective. The objective of business enterprise is to earn a profit. How far the business enterprise is succeeded in achieving the profit earning, that will be shown through the profit and loss account in the income statement. సో బేసిక్గా మనము వ్యాపార సంస్థ యొక్క ధ్యేయము లాభార్జన అనుకుంటే ఆ లాభార్జనను ఆ వ్యాపార సంస్థ ఎంతవరకు సాధించగలిగింది అనేటటువంటి దాన్ని మనము ఏ స్టేట్మెంట్ ద్వారా తెలుసుకోగలుగుతామంటే ప్రాఫిట్ అండ్ లాస్ అకౌంట్ ఆర్ ఇన్కమ్ స్టేట్మెంట్ ద్వారానే we will come to know that is the business organization or business firm is succeeded for earning the objective, earning the profits. And after preparing these two statements, in addition to these two statements, there is another statement which is also very important statement because it is mandatory statement for as per the accounting standard 3. Hence, we are also just to know the meaning of cash flow statement here itself. It reports cash receipts and payments classified according to the organization's major activities. This cash flow statement always reports the receipts and payments of major activities of the business organization. How do you define or how do you classify the major activities of the business enterprise? It depends upon the three activities, that is operating activities, investment activities, and financing activities. We will come to know what is operating, what is investment, and what is financing activities under cash flow statement. Reports the net cash inflows or outflows. This cash flow statement is reporting what is the exact net cash inflows and outflows for each activity. That means for operating how much, and for investment how much, and for financing activities how much is inflow and how much is outflow. That is for the overall business also we will come to know while preparing the cash flow statement. According to the accounting standard 3 revised, this cash flow statement need to be prepared and presented as per the Companies Act 2013. After Companies Act 2013 once implemented, came into force, this accounting standard 3 revised. As per that, we need to prepare the cash flow statement. Earlier to that, we are generally used to prepare in different manner, but now we need to prepare it in a specified manner, which is clearly mentioned in the Companies Act. Then nature of financial statements. The financial statements are prepared for the purpose of presenting a periodical review or report on the progress by the management. Why do you want to prepare the financial statements? The purpose of presenting the periodical review or report, the progress by the management. Any organization generally, it requires periodical review or report on the progress. For these two things, periodical review as well as report on the progress of the business, that is to be presented to the management. For that reason, we need to prepare the financial statements. These financial statements are the results of the combined effect of the financial statements are not an individual item. It's a combination of different items, that is recorded facts. What do you mean by recorded facts? Recorded facts, it starts with bookkeeping and again it transmitted into the journals, recorded in the accounting books. What are the accounting books? Journal, ledger, trial balance. These are all comes into the accounting books. When you are recording into the accounting books, you need to record into the historical cost, historical transactions. Say for example, purchases, sales, bills payable, bills receivable, sales turnover, assets, liabilities. Each and everything is recorded and that should be reflected into the balance sheet as well as profit and loss account. So recorded facts is a base for preparation of the financial statements. The recorded facts are recorded as per the historical cost as well as the historical data. And then coming into the accounting conventions, here I wanted to mention with you all that the accounting conventions and concepts which are unavoidable, which are indispensable, which are more important to the preparation of your exam, because any financial statement which is going to be impacted or influenced by the accounting conventions and concepts, whereas these accounting conventions and concepts which is not given in the syllabus, but indirectly there is 100% chances to ask the questions on accounting conventions and concepts. Say for example, record anticipated losses but not the profits. As per the conservatism convention always says that in an accountant you need to record anticipated losses but not the profits, but not the anticipated profits. We generally prepare accounts, we generally solve the problems, but we do not know where the accounting conventions and concepts are influencing directly or indirectly back to our practice. Say for example, when we are preparing the consignment accounts, in consignment accounts always you will see in the problem normal loss, but there is no normal gain which is not given in the problem. Any problem if you read in the consignment account, we always come across normal loss. If the actual loss is less than the normal loss, you have abnormal gain. If you have actual loss is more than the normal loss, you have abnormal loss. Where is the normal gain? Normal gain you cannot expect as per conservatism convention. That is the reason why we do not come across the normal gain in any problems. Say for example, in another example, you can recollect what we are practicing in accounts. We generally practices provision for bad debts on debtors. Why don't we create provision for good debts or provision for good debts on creditors? You are expected that we are not going to receive some amount from the debtors, but at the same time expect that some amount we are not going to pay to the creditors. Is it so? But as per the accounting convention of conservatism, we are anticipating and recording only losses but not the profits. So all these accounting conventions, like there are 4 accounting conventions, 10 accounting concepts, all these accounting conventions and concepts are going to influence your financial statements. Hence, as a student, you need to prepare perfectly about the accounting conventions as well as concepts. And then coming to the postulates. This postulates is in another way you can call it as assumptions. In the going concern concept, always we are assuming that the firm is going to be going concern. It is going to be like a perennial river. It is going to be like a perennial river. Always whenever we start the business, we keep the board saying that the Lakshmi Venkateswara Enterprises starting on so and so date. But we are not going to mention on the board the business is going to be closed on so and so date. What is the reason? The reason is very simple. If you are going to mention the closing date on the name of the board, then the credit worthiness in the market, it is not possible to the firm to create credit facility in the market, because everybody knows that you are not going to be there in the market after a certain period of time, because already you mentioned on the board. We know that the firm, once it is exist, definitely it is going to wind up on certain date due to some reason. But assumed that we are not going to close this business, the business is going to be continuously running, that is going concern. It's like a perennial river. జీవనది లాగా మన వ్యాపార సంస్థ నిరంతరాయంగా కొనసాగుతుందనేటటువంటి ఒక తలంపుతో మన వ్యాపారాన్ని కొనసాగిస్తాము. దానివల్లనే మనకు మార్కెట్లో క్రెడిట్ అనేటటువంటిది పుడుతుంది. ఇట్స్ లైక్ ఏ assumption. It's like our convention. We are practicing it, we are doing it for the sake of the business. And as per the going concern concept, we are doing it one another thing, that is costless depreciation. As and when you purchase any fixed asset, what we are generally do, we will deduct the depreciation from the cost of the machinery, and the depreciation is debited into the profit and loss account. The reason is very simple. Assuming that the firm is continuously running, after a certain period of time, the asset is not going to be used for the purpose of production, because due to the quality of the products matter a lot. That is the reason why we need to replace the new machinery. If you want to replace the machinery, you need to have some fund to purchase the new machinery. For that purpose, every year we are charging the depreciation into the profit and loss account, so that our profit is going to be reduced, and the reduced profit is transferred to the profit and loss account liability side. Then your asset reduced, that is to be transferred to the your balance sheet asset side. Whatever debited into the profit and loss account debit side, that depreciation is going to be transferred to the depreciation fund account. That depreciation fund account is used after the 10 years or 15 years down the line for purchasing the new machinery, as per the going concern concept. So as a student, as a competitive exams, you need to recollect or connect to your concepts and conventions to the practice. Definitely the questions, objective questions, are going to be in this direction. And then coming to the monetary postulate, it's nothing but money measurement concept. This is not money measurement concept. Monetary postulate is something accountant is not going to consider the price level changes. Accountant is not going to consider the inflation for recording the accounts. As and when he records the cost, that means actual cost of the product as per the historical data. But he is not going to consider the price level changes. He is not going to consider the inflation. That is the another postulation or assumption which we are practicing. But nowadays it's a recent trend which has come across. There is a price level changes or price level inflationary accounting is also came into existence. But how many members are practicing? That's a matter. And another thing is realization postulate. This realization postulate means it's nothing but a realization concept. As per the realization concept, you have to record into the books of accounts as and when it arises the receipt or payment. Either it is recorded into the books of accounts. These are the different postulates or assumptions when you are preparing accounting practices or recording accounts in the books of accounts. So all these recorded accounting conventions all are going to affect the financial statement, personal statement. As you all know, the material convention. As per the materiality convention, sometime we will decide this is an expenditure. Sometime we will decide this is an asset. It depends upon the nature of the business. It depends upon the nature of the accountant or judgment of the accountant. So the financial statements is also affecting or a combination of personal judgments. And finally, the accounting standards and guidance notes. The financial statements always prepared based upon the accounting standards as well as guidance notes in preparing the financial statements. Sorry. These are the combined effects of different aspects. Based on these, we will prepare the financial statements. Attributes of financial statements. What are the attributes of financial statement? The financial statements must be relevance. Whatever we are preparing, which must be relevant for decision making purpose, for analysis purpose, for the all the stakeholders. Either it may be shareholders or competitors or labor unions or government, whoever may be. For their purpose, the financial statements are more relevant. Accuracy and freedom from bias. So always these financial statements must be accurate and freedom from bias. Whoever prepares the financial statements, sorry, they should not allow their personal prejudices to color the facts, not to hide the facts when you are preparing the financial statements. Comparability. Financial statements are such in a position which are prepared to compare the each and every year or from company to company. That is possible through the financial statements. Analytical presentation. This classification of data is most important at the time of analytical presentation. How do you classify the data? On what basis you are classifying the data? How you are making it classification or segregation depending upon different categories. that is most important under the analytical presentation. Promptness, again it talks about accuracy, promptness, and generally accepted accounting principles. That's what I covered already. Accounting concepts and conventions, some of them, all these accounting concepts and conventions, accounting principles, or comes into the generally accepted accounting principles. This gap is most important for the financial statements. If an accountant is not followed the generally accepted accounting principles, finally it impacts on the financial statements. Consistency, this is another convention of accounting. This consistency always direct bearing upon the comparability. When you are not maintaining the consistency at the time of preparation of accounts, say for example in the valuation of stock, once you are preparing and based on LIFO and moving to the FIFO and moving to the replacement method, moving to the some other weighted average method, then automatically the stock values are differ from year to year. But it is not actually happened in the business because of only changing the valuation of stock. Your stock value has been changed. That means an accountant has not been maintained the consistency. అకౌంట్స్ తయారు చేసేటప్పుడు, అకౌంట్స్ మనం నిర్వహించేటప్పుడు సరైనటువంటి నిలకడను మనం ఫాలో కావాలి. అన్అవాయిడబుల్ కండిషన్స్ లో మాత్రమే మనము చేంజ్ చేయాలి మెథడ్. అదర్వైజ్ వీఆర్ నాట్ ఇన్ ఏ పొజిషన్ టు గో ఫర్ చేంజింగ్ అవర్ method. If at all, if you want to change the method, the reason why you are changing the method, it is to be noticed, keep into the notice of the board of directors, then only we will move into the changing of accounting procedures, either in depreciation case or valuation of stock case. In any accounting procedures, we are not directly allowed to change as and when accountant wants to change. If at all it requires really something happened and it is really needed to change, then only allowed to change the accounting procedures. Authenticity is most important factor in a financial statements. At the time of preparation of the accounts, authentic information is most important. Any biased information is not allowing into the accounts. Then only the qualitative financial statements can come into picture. Compliance with the law, always this accounts as well as financial statements must be compliance with the law. As per the Companies Act 2013, this section 2 and subsection 2 as well as section 129 of the Companies Act 2013, this all the business enterprises must have prepare the cash flow statement, balance sheet and profit and loss account as per the schedule 3 which is given in the Companies Act 2013. And then objectives of financial statement. What are the objectives? The financial information about economic resources and obligation of a business enterprise. Reliable information provide cheyali, that is the first objective. And the second objective is to provide reliable information about the net resources. Net resources is nothing but resources less obligations. Indirectly you can say net assets of an enterprise that results from its activities. To provide financial information that assist in estimating the earning potentials of a business. Financial information ni manam provide cheyagalagali. It assists estimating the earning potentials of a business. ఆ సంస్థ యొక్క లాభార్జన యొక్క సాధ్యాసాధ్యాలను గురించి మనకి ఆర్థిక సమాచారం ఇవ్వడం జరుగుతుంది. టు ప్రొవైడ్ అదర్ నీడెడ్ ఇన్ఫర్మేషన్ అబౌట్ చేంజ్ ఇన్ ఎకనామిక్ resources or obligations. As and when conditions, economic resources or obligations lo change vachinappudu, whatever the necessary information that is to be provided by the financial statements. And to disclose to the extent possible other information related to the financial statements that is to be relevant to the need of the users of these statements. So it's very simple. Not only providing the financial statement, when you are reading the financial statement, a reader have some doubts. That doubts should be cleared by providing additional information, that is other information related to the financial statements that is to be disclosed by the accountant at the time of preparation of the financial accounts and as well as statements. That is most important. That is supporting documents which are readily available with the financial statements, which are more useful to the reader to understand effectively the financial statement as and when he has any doubt while going through the additional information which is supplied along with the financial statements. And then the recent trends in presenting financial statements is a statement of profit and loss account and balance sheet has been changed as per the Companies Act 2013. Earlier to that, we need to prepare in the form of T-shape. Now we need to prepare the statement of profit and loss account and balance sheet in the schedule format as per the Companies Act 2013, and as well as highlights. Companies Act 2013 says whatever the highlights which are there in the profit and loss account and balance sheet, that is to be presented before the profit and loss account and balance sheet. బిఫోర్ ఎంటరింగ్ ఇంటూ ప్రాఫిట్ అండ్ లాస్ అకౌంట్, అంటే ప్రాఫిట్ అండ్ లాస్ అకౌంట్ బ్యాలెన్స్ షీట్ మనం చదవడానికి ముందుగానే ఈ ఈ ప్రాఫిట్ అండ్ లాస్ అకౌంట్ బ్యాలెన్స్ షీట్ లో ఉన్నటువంటి హైలైట్స్ అన్నిటినీ ముందునే ప్రజెంట్ చేస్తే వాటి వల్ల రీడర్ కి రీడబిలిటీ పెరుగుతుంది, మోర్ ఇన్ఫర్మేషన్ హీ కెన్ అక్వైర్, అండ్ దెన్ టైం కన్జ్యూమింగ్ కూడా ఉంటుంది. తద్వారా వేరెవర్ హీ వాంటెడ్ టు యూజ్ ఇట్, దట్ హీ ఇన్ ద సెన్స్ స్టేక్ హోల్డర్స్, డిపెండ్స్ అపాన్ షేర్-హోల్డరా, కాంపిటీటరా, whoever may be, either employer, trade union wala, government wala, whoever may be, all stakeholders. And then cash flow statement. This is also recent trend. After 2013 Companies Act, the cash flow statement format has been changed and it has been included into Accounting Standard 3. And as per the Accounting Standard 3, every company, they must and should follow and submit the cash flow statement because it is a mandatory statement now. As far as the profit and loss account and balance sheet, you are also prepare cash flow statement as per the Companies Act 2013, as per the Accounting Standard 3. So that is the recent trend. Recent trend in the sense from last 10 years onwards there are changes. Provision of important accounting ratios. Whatever the ratios which you feel are very important for the business firm, you can maintain some provisions. And also disclosure of accounting policies. As and when I already told you regarding consistency, conservatism, materiality, all related to these accounting conventions and concepts. Apart from that, any accounting policies which we are following while preparing the accounts, for all these policies and procedures which we are adapting in preparation of accounts, that is to be clearly disclosed. That is the very, very important aspect. And use of charts, graphs and diagrams. It is a very important aspect in a recent trend. A layman can also understand the balance sheet and profit and loss account when we are presenting it in the form of charts, graphs and diagrams. That is the most important. That is the reason why nowadays it's mandatory for the companies or business enterprises to show their financial statements into charts, graphs and diagrams to make the readers to understand very easily. Use of schedules. That's what I already mentioned. As per the Companies Act 2013, the schedules have been introduced in the preparation of the financial statements. Impact of price level changes. That is nothing but inflationary accounting, price level changes accounting. It's brought into the accounting practice, and the firms are also practicing nowadays. As per the price level changes, as per the inflation, we are maintaining the books of accounts. That means the price level changes have been taken into consideration of preparation of accounts. This is the recent trend. And then rounding of figures. When you are having the values into the 0 or 0.5 or 0.6 like that, always it is suggested to round up the figures. These are the recent trends in presenting financial statements. Financial statement analysis. This is exactly what we need to discuss. Why do you want to analyze the financial statements? The financial statement analysis is important to understand and to take the decisions. See, financial statements prepared by the accountant, but when you want to analyze it, why do you want to analyze it? Analysis is to take the decision making by the manager or management accountant. In this case, what we are going to do exactly? We are going to do the rearranging of the financial statement for comparing and measuring the significance of financial and operating data. We are not going to do anything in a principled manner. We are going to do the financial and operating data in rearranging in a systematic procedure for comparison and measuring the significance of the business activities. This helps to reveal the relative significance and effect of items of the data in relation to the time period. When you are rearranging and comparing and measuring the data, that helps to reveal the relative significance and the effect of items of the data in relation to the time period from one period to another period between two organizations also. Even from within the organization, from first year to second year, from one organization to another organization, if you want to compare, it is always very easy when you are arranging the data in a systematic manner, in a same manner in both the companies or in a same manner for both the years, then it is very easy for us to compare and to reveal a very significance or effect of items and data, effect of that items of the data in relation to the time period or between two organizations. And objectives of financial statement analysis. What are the objectives? The first objective is present the future earnings capacity of the concern, capacity of the firm. Present and future earning capacity we will enable to come to know. And operational efficiency of the firm is also department wise can also be assessed. That means operational efficiency of the concern and overall operational efficiency can be assessed through the financial statement analysis, as well as department wise operational efficiency can also be measured. Solvency of the firm. What is solvency? Is the firm able to repay the loans for long term as well as short term, can be determined through the financial statement analysis. That is most important. For example, a banker or creditor is always looking into the financial statements. Is the firm is in a position to pay our debts, pay our dues or not? That is through the solvency of the firm. Comparative study is possible by the analysis of financial statement. That's what I already mentioned. We are preparing this financial statement by rearranging the data which is available in financial accounts to make it comparative study between the organizations or within the organizations across the years. Analysis of past results is of a great help in forecasting the future results. This is another objective. When we are analyzing the past results, it is very helpful for us to forecast the future results. That's what we say always. Plan is nothing but past experience and present conditions. Past experience plus present conditions is nothing but your forecasting of the future results, and also facilitates assessment of financial stability of the concern. This financial statements facilitates to assess the financial stability of the concern. Is the financially firm is going to be stable? In which year, how many years it takes to time to stabilize the firm? This is about the objectives of financial statements. And then coming into the methods of analyzing financial statements. There are 6 methods of analyzing financial statements. These financial statements consist to determine whether or not the financial position or results of operation as well as the financial progress of the company are satisfactory or unsatisfactory. Why do you want to prepare the financial statements? Why do you want to make the financial statement analysis? It's only because of to know the satisfactory condition or unsatisfactory condition with regard to the financial progress of the company. With respect to financial progress of the company, is the satisfactory condition which is exist or unsatisfactory condition is prevailed. To know that, we need to make a financial statement analysis. For analyzing the financial statements, we have to go through some methods. These financial statement analysis methods consist of comparative statements, common size statements, trend ratios, ratio analysis, cash flow statements, and funds flow statement. In this class, we will try to complete this comparative, common size, and trend ratios. What do you mean by comparative statement? This comparative statement is used to design and to provide time perspective to the various elements of financial position contained therein. That means this comparative statement is preparing based upon time perspective, that is for the current year to the last year, or from 24 to 23. You can compare it. Like that, we will have the 2 years, the time periods. Absolute money values of each item separately for each of the periods stated. First, we have to take the absolute money values for the 2 time periods, period 1, period 2. And compare from period 2 to period 1 and try to assess is the increase or decrease in the absolute money value or absolute data in terms of monetary values. Increase and decrease in terms of percentage. And then after, once you come to know that increase and decrease of absolute data, then you have to convert that into the percentages. And finally, we will have comparison expressed through the ratios, percentage of, and finally percentage of totals. Now, these comparative statements again classified into 2 types. One is comparative balance sheet and another one is comparative income statement. As we already know the meaning of balance sheet and meaning of income statement, we generally just go through the glance once the what is comparative balance sheet. It shows the balance of accounts of assets and liabilities on different dates and also the extent of their increase or decrease between these 2 dates. That means 2 different dates ki manaki assets and liabilities untai. And then we will consider the increase and decrease between the 2 different dates, and based on that we will find out is the positive direction or negative direction this increase or decrease is happening, and then finally converting into the percentages. And now we will see the specimen pro forma of comparative balance sheet. See, this comparative balance sheet, this is given for the first 2017 and this is for 2018. You need to compare with the 18 with the 17. When you are comparing with the 18 with the 17, in the 18, what happened? It reduced. What is that? Cash and bank balance is drastically reduced to 2000 rupees. How much is reduced? That difference has to be find out. The difference has to be checked. 23,600 నుంచి 2000 కి పడిపోయింది. ఎంత మైనస్ అయింది? 21,600 రూపీస్ మైనస్ అయింది. This is to be calculated in percentage. How do you calculate? The calculation is very simple. This 21,600 rupees percentage of increase or decrease. How much is there? 21,600 divided by 23,600. Then you will get how much? 91,500 rupees. So like that, how much change has been happened, that is to be known. అంతేగాని మనము యాక్చువల్ వాల్యూని తీసుకోకూడదు. యాక్చువల్ వాల్యూని కంపేర్ చేసి ఇంక్రీజ్ అయినా డిక్రీజ్ అయిన వాల్యూని బేస్ ఇయర్ వాల్యూతో కంపేర్ చేయాలి. బేస్ ఇయర్ వాల్యూ ఎంత ఉంది? 23,600 రూపీస్ ఉంది. సో 23,600 రూపీస్ మల్టిప్లై చేసినట్టయి మనం 100 తో మల్టిప్లై చేస్తే 91.52% వస్తుంది. Like that, each and every item is comparing with the second year with the first year, and the difference will be recorded in the third column, and third column divided by first column, you will get the percentage change. Like this, we have to prepare the comparative balance sheet. And I am shows operating results for a number of accounting periods. That shows the financial position of assets and liabilities for a different number of accounting periods, but it shows operating results, that is financial results for a number of accounting periods. So the specimen of comparative income statement is like this. A is given for the previous year, B is showing current year, and comparing from current year to previous year, that means B minus A, you will get the C. And how do you calculate D? D is equals to C by A, you will get the D, that is percentage change is in increase or decrease. If it is a decrease, this is a minus value. If it is an increase, it is a positive value. So then after comparative statement, then common size statements. Common size statements, we are taking it one value as common. One value is considered as a base value for comparing within the year. We are comparing with the within the year. We are going to consider one value is taken to be base value. Now we will see the common size income statement. In the common size income statement, we are considering it one value is 100. 100 అనే దాన్ని ఏ దాంట్లో తీసుకుంటాం, సేల్స్ లో 100 అనుకుంటే ఇంకా తక్కిన వాల్యూస్ అన్ని ఆ సేల్స్ లో ఎంత పర్సెంటేజో మనం క్యాలిక్యులేట్ చేస్తాం. సో నౌ యూ కెన్ సీ ది కామన్ సైజ్ ఇన్కమ్ స్టేట్మెంట్. కామన్ గా ఏ దాన్ని తీసుకోవాలి? ఫర్ ఎగ్జాంపుల్ ప్రీవియస్ ఇయర్ ఉంది, కరెంట్ ఇయర్ ఉంది. వీఆర్ నాట్ గోయింగ్ టు కంపేర్ హియర్ విత్ ది కరెంట్ ఇయర్ విత్ ది ప్రీవియస్ ఇయర్. What we are going to do? We are taking previous year separately and current year separately. In the previous year, first column ఏముంది? రెవెన్యూ ఫ్రమ్ ఆపరేషన్స్ ఉంది. ఈ రెవెన్యూ ఫ్రమ్ ఆపరేషన్స్ అనే దాన్ని మనము 100 గా కన్సిడర్ చేస్తాం. 100 ఫర్ బోత్ ది ఇయర్స్. ఈ 100 అని తీసుకున్నప్పుడు అదర్ ఇన్కమ్ అనేది ఒక ఎంతో అమౌంట్ ఉంది. ఆ అమౌంట్ ఈ యొక్క ఫస్ట్ అమౌంట్ లో ఎంత పర్సెంటేజ్? దట్ మీన్స్ అదర్ ఇన్కమ్ డివైడెడ్ బై రెవెన్యూ ఫ్రమ్ ఆపరేషన్స్ ఇంటూ 100 వేస్తే మనకు పర్సెంటేజ్ వస్తుంది ఫర్ ప్రీవియస్ ఇయర్ యాజ్ వెల్ యాజ్ ఫర్ కరెంట్ ఇయర్. వీఆర్ నాట్ గోయింగ్ టు కంపేర్ ది అబ్సల్యూట్ వాల్యూస్ ఆఫ్ ప్రీవియస్ ఇయర్ అండ్ కరెంట్ ఇయర్ హియర్ బికాస్ ఇట్ ఈస్ ఎ కామన్ సైజ్. వీఆర్ టేకింగ్, వై ఇట్ ఈస్ కాల్డ్ ఎస్ ఎ కామన్? The reason is we are taking one value as common for calculating percentages. Here in this income statement, we are taking it as a common as revenue from operations or net sales is considered as common variable for comparing with the other variables. This is common income statement, common size income statement. Then common size balance sheet. In the same manner, here we are taking it as total assets and liabilities as considered as 100 common. Now you can see this. If you observe here, the first is liabilities is given. I don't think so is it visible or not, but you can try to understand this 100 is common, that total liabilities is going to be 100. Out of that, what is the share capital? What is the retained earnings? What is the creditors? How much is the bank overdraft? Each and every variable comparing with the total liabilities, and then you will get the some percentage value for previous year as well as current year. Like that we have to do the for both the assets and liabilities. And then coming into the trend ratios. In this trend ratios, what happens? We are going to consider the index numbers of the movements for the various financial items. Various financial items in the sense there are a lot of assets and liabilities, there are expenses and incomes. Each and every item, what is the movement which is happening, which is to be measured in terms of index numbers. It is a statistical device. Trend ratio is a statistical device applied in the analysis of financial statements to reveal the trend of the items with the passage of time. Say for example, first year 200 rupees sales, and then 400 rupees, and then 600 rupees, and then 700 rupees. Like that, for over a period of time, we are having the data with us for 4 years. Now, you consider the 2021 data as 100. And now, second year 2022 data becomes, say for example, 150 sales for 2021, 250 sales for 2022. Then 250 divided by 150 into 100, then you will get the percentage increase from 21 to 22 with respect to sales. Like that, for each and every year, we have to calculate the ratios and observe the trend. Is the trend is uptrend or downtrend, or maintaining the same line of maintenance. That means there is no growth, there is no decline, maintaining the status quo. That is to be observed while measuring these trend ratios. These trend ratios always shows nature and rate of movements. What is the rate of movement which is happening in a financial factors? What is the rate of movement exactly? How much percentage is moving? And also it provides a horizontal analysis. See, for example, in a common size balance sheet, in a common size balance sheet, in a common size income statement, we are having vertical analysis, whereas comparative statement as well as trend ratios, you will have horizontal analysis. You can have an objective question. Horizontal analysis will be projected through common size statements, comparative statements, trend ratios, or D is B and C. In that case, the trend ratios and comparative statements can be projected through the horizontal analysis and reflect the behavior of various financial items with the passage of time. So here you need to understand horizontal analysis, vertical analysis, which type follows horizontal analysis, which type follows vertical analysis. Trend ratios, last point, trend ratios can be graphically presented for better understanding. I will finish within a minute, within 5 minutes. Please wait for 5 more minutes. On this computation of trend ratios, this trend ratio, generally we are going to take it as a normal year is considered as a base year. Say for example, we are comparing data from 19 to 24. What do you mean by normal year? Say for example, in the 2020 there is a COVID. 2020, 21, 22, up to 21, 22, 22, 23, there is an impact of COVID. In that case, these are all normal years. These are all abnormal years. Due to COVID, the business has got so much of losses. So we are not going to consider these abnormal years as base years. Generally, we have to take the base year as a normal year, which is not, which should not affected with any other specific cases. And every item in the base statement is stated as 100. So that means in 2019, each and every item is considered as 100. And comparing with 19 with 20, 19 with 21, 19 with 22, like that you have to compare with base year, from base year to present year. Trend percentages of each item in other statement is calculated with the reference to same item in the base statement by using the following formula. Absolute value of item, say cash. Why do you say cash? It's a cash is an example. You can say fixed assets, you can say any liability, you can say any expense in other statements, divided by absolute value of same item in base statement. So base statement in our example, we have considered it 2019, compare with 20, 19 with 21, 19 with 22, 19 with 23. So that means cash of 23 year divided by cash of 2019 year into 100. Cash of 2022 year and divided by cash of 19 year into 100. Like that we have to calculate the trend ratios for each and every item. In this case, and finally we will come to know what are the limitations of trend ratios. These trend ratios practices have not been consistently followed year after year. Accounting practices, when you are not maintaining the consistency, these ratios becomes incomparable and those misleading. So I already told you at the time of discussing basic fundamentals of financial statements, the accounting concepts, conventions, accounting rules, accounting policies must be maintained consistently. Otherwise, these accounting trend ratios becomes incomparable and thus misleading. And make sure that everyone should follow the consistently accounting policies. Otherwise, there is no meaning of trend ratios. Trend ratios do not take into consideration the price level changes. As exactly we have discussed, this inflationary changes is not to be considered by the accountant as generally. So these trend ratios also not taken into consideration of these price level changes, because trend ratios are using the historical data, that is data what it exactly happened, that is to be considered for calculation of trend ratios. Because of this reason, increasing trend in sales might not be the result of larger sales volume sometime, but maybe because of increased sales price due to inflation. సో సమ్ టైమ్ సేల్స్ ఇంక్రీజ్ కాకపోయినా ప్రైస్ లెవెల్ ఇంక్రీజ్ అయినప్పటికీ దాన్ని కూడా మనము సేల్స్ ఇంక్రీజ్ అయినట్టుగా కూడా కన్సిడర్ చేయాల్సి వస్తున్న అవకాశం ఉంటుంది. దెన్ ట్రెండ్ రేషియోస్ మస్ట్ ఆల్వేస్ రీడ్ విత్ అబ్జల్యూట్ డేటా ఆన్ విచ్ దే ఆర్ బేస్డ్. ట్రెండ్ రేషియోస్ మనం ఎప్పుడైనా రీడ్ చేసేటప్పుడు అబ్జల్యూట్ డేటాను కూడా పక్కన పెట్టుకొని రీడ్ చేయాలి. ఎందుకంటే ఒకసారి ఒక డేటా సే ఫర్ ఎగ్జాంపుల్ 1000 రూపీస్ క్యాష్ ఉందనుకోండి, ఆ క్యాష్ నెక్స్ట్ ఇయర్ 2000 రూపీస్ అయింది అనుకో, ఎంత పెరిగింది ఇప్పుడు? 100% పెరిగింది. సో మనం 100% అని రీడ్ చేస్తే ఇట్ డస్ నాట్ రిఫ్లెక్ట్ యాక్చువల్ కండిషన్ ఆఫ్ ది బిజినెస్. అక్కడ 1000 రూపీసే క్యాష్ ఉంది, బట్ 1000 రూపీస్ పెరిగింది, ఫైనల్ గా 2000 క్యాష్ ఉంది మన వద్ద. సో దట్ ఈస్ నాట్ ఏ గుడ్ కండిషన్ యాజ్ పర్ కరెంట్ రేషియో. బట్ సమ్ టైమ్ మీ దగ్గర 4 lakhs ఉంది ఏదో, అది అమౌంట్ ఏమైంది 5 lakhs అయింది, అంటే 1 lakh పెరిగింది. 1 lakh పెరిగిందంటే ఎంత పెరిగినట్టు? 20% పెరిగింది, 20%. సో ఇప్పుడు 20% పెరిగిందంటే ఇంత తక్కువ పెరిగిందా అనుకుంటాం, బట్ వెరాజ్ ఇక్కడ 1 lakh రూపీస్ పెరిగింది. సో ఆల్వేస్ వెన్ ఎవర్ యూ రీడ్ ది ట్రెండ్ రేషియోస్, you are not supposed to read the alone trend ratios. Always read the trend ratios with the absolute data as per the given. Then the trend ratios have to be interpreted in the light of certain non-financial factors. ఈ ట్రెండ్ రేషియోస్ అనేటటువంటివి నాన్ ఫైనాన్షియల్ ఫ్యాక్టర్స్ లైక్ ఎకనామిక్ కండిషన్స్, గవర్నమెంట్ పాలసీస్, మేనేజ్మెంట్ పాలసీస్ వీటిని రిఫ్లెక్ట్ చేయవు. ఎందుకు అంటే వీఆర్ నాట్ టేకింగ్ ఇన్ టు దాట్ దీస్ కండిషన్స్ ఇన్ టు అవర్ అకౌంటింగ్ పాలసీస్. సో the trend ratios have to be interpreted in the light of certain non-financial factors also to be considered. Non-financial factors కూడా మనం కన్సిడర్ చేస్తూ ట్రెండ్ రేషియోస్ ని ఇంటర్ప్రిట్ చేయాలి. దట్ ఈస్ lacking in trend ratios అనేది another limitation of the trend ratios. Today in this class what we have discussed is what is financial statements, what are the financial statements, how many types of financial statements, what do you mean by financial statement analysis, objectives, attributes, recent trends in financial statement analysis, and then coming to the methods of financial statement analysis. Under that we have come across 6 methods of financial statement analysis. Out of that 3 methods we have covered elaborately in the class, and based on this I hope you are going back and read properly. While reading this common size, comparative and trend ratios as per your syllabus, you connect with the accounting policies, accounting concepts, accounting conventions, accounting principles. All these generally accepted accounting principles must be taken into consideration while studying, while understanding common size, comparative and trend ratios. That is most important. You might not getting direct questions from common size, comparative and trend ratios. Most of the time you will get the questions connected with the accounting conventions and concepts. That is it from my side. Thanks for listening patiently, and thank you for the organizers.
Thank you very much, sir. Thank you, sir. Rangana sir. Okay, dear participants, we'll meet tomorrow same time and same resource person. Thank you. I'm going to end the meeting, sir. Rangana sir, you please end that Google Meet, sir. You please end Google Meet.
I am ending Google Meet. Yes, done.